When you start thinking about investing in the stock markets, you'll hear a lot of financial jargon thrown at you. Today, we're going to talk about some of this jargon. We're going to talk about debt, equity, and how companies raise funds to start, run, and grow their businesses. I have a dream. Well, just kidding. I do have a dream, but I can't sing, and my dream is to open a restaurant with healthy and delicious food, quality service, and reasonable prices. And if I was going to open a restaurant like this, I would need an upfront investment to cover the rent, the people, the groceries, and all the other upfront costs that are involved with opening something like that. Let's say maybe £50,000 is what I'd need. If you speak to your bank at this stage and ask for a loan, most times the loan will be rejected, or in return for the loan, your bank would ask you for something that's valuable, such as property or equipment against which they would give you the loan, and this is something known as collateral. Let's take a step back and talk about something you'll hear a lot about when speaking to finance professionals: the risk-reward ratio. Finance professionals calculate this ratio using two factors. One, the level of risk in the investment, and two, the return they can expect to get out of the investment. Take, for example, if you go to the bank to get a mortgage in order to buy property. The interest rate that they charge you will depend on the amount of deposit you put up front and could also depend on your credit rating. Why? Because if your credit rating is low, this means it's a higher risk for them and they'll want a higher return for that risk, and then therefore they will charge you a higher interest rate. At the same time, when a company such as Apple asks for a loan, the risk is very low, and therefore the bank actually gives Apple very low interest rates because they have strong cash flows to back up the money that's being lent. Take a guess. How much do you think Apple is being charged for its $2.5 billion of debt in March this year? Any ideas? A very small 2%. Low risk, low return. Conversely, when you go to bet in a casino, you often get double or nothing odds. High risk, high return. So, as we can see, the risk for debt with Apple, the risk with buying a mortgage or buying a property, and the risk at betting at a casino are very different profiles, and therefore the expected returns are also very different. Going back to my restaurant, it's very unlikely that the bank would give me a loan because it would be considered very high risk. Statistics show that 90% of new businesses fail. Mine won't, of course, but the bank won't see it that way. So in this scenario, the bank wouldn't be able to calculate an interest rate to compensate for the risk they'd be taking. What happens in these scenarios where there's a high-risk business? Well, this is where equity comes in. Equity is when an investor gets a share in the business, and this means they share the upside and the downside for what happens with the business. Let's say you take out a loan of £100 to grow some apples. Irrespective of whether you grow 1 apple, 3 apples, or 6 apples, you still have to pay the interest to the bank, and you'll pay the same interest whatever you grow. Instead of debt, imagine for that £100 we gave a 30% equity stake in the business. Now, if you grow 3 apples, you have to return 1 to the investor, and if you grow 6 apples, you have to give 2 of them. However, if you grow nothing, you own nothing, which means for the investor, they share an upside and a downside with you for the returns the business makes. Let's bring some structure to all of this. There are 3 ways a company can raise funds: debt, equity, or convertible debt. Let's just talk about debt and equity today. You go to a bank to get debt, which is usually offered when the business has steady cash flow to pay back the interest and the risk is relatively low. In order to raise equity, you usually go to the stock markets or private investors. This is normally when the upside is high, but the risk is also high. This means there could be significant downsides, and in some cases, there's the risk of a complete failure of the business. Now that you understand the difference between debt and equity, and you know what a risk-reward ratio is, would you give me £20,000 for a 10% stake in my restaurant? Let's bring some structure to all of this. Freaking hell. Okay, go for it again. Now that you understand the difference between debt and equity, oh shit, I forgot about the risk reward rate. When you go to a casino, oh freaking hell. No, keep going.